Welcome to the Explainer. Okay, let's talk about the incredible AI boom. It feels like this massive, once-in-a-lifetime opportunity, right? But some are warning it could be a once-in-a-lifetime crash instead. So today, we're going to dig into what's really going on and what it all means for your money. You know, the legendary investor John Templeton once said the four most expensive words in investing are, "This time is different." And that quote just hits the nail on the head, doesn't it? It perfectly frames the big question everyone is asking about AI. Is this a truly new chapter, or are we just repeating a very familiar and potentially very costly pattern? Because, let's be real, we have been here before. Remember the late 90s? Investors were throwing money at any company that had .com in its name. For a little while, everyone felt like a genius. And then, poof, the bubble burst. The Nasdaq crashed nearly 80%, and less than half of those internet companies even made it out alive. That same kind of frantic energy is definitely in the air today. So to really wrap our heads around what's happening, here's our game plan. We're going to start by looking at who's actually driving this boom. Then we'll dive into the major warning signs that a crash could be coming. And we'll finish up with a practical, no-nonsense game plan for you, the investor. So who is driving this whole revolution? Well, it turns out the fate of the entire market is pretty much being decided by just a handful of companies. They're called the Magnificent Seven. And these tech giants are locked in this all-out arms race to dominate artificial intelligence. And believe me, their actions are shaping the entire global economy. Just look at this. These 7 companies, we're talking Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia, they now make up over a third of the entire S&P 500. That concentration is just staggering. It means that even if you own a simple, safe index fund, you're actually making a massive bet on the success of this very small group. And to fuel this arms race, they are planning to spend absolutely eye-watering amounts of cash. We're talking hundreds of billions of dollars combined. You've got Microsoft funding OpenAI, Amazon building the massive cloud infrastructure. The whole system is built on this spending. That's over $330 billion in planned spending for just 1 year. To put that in perspective, that's more than the entire GDP of Finland. This mountain of cash is so huge that you could argue it's single-handedly propping up the entire U.S. economy. Without it, we might already be in a recession. So the huge question is, how long can this spending spree possibly last? And this is where things start to get, well, a little strange. This leads us to our first big warning sign, which is all about how this money is actually moving around, and it reveals a major reason for concern. People are starting to call it the AI money machine. Basically, it's this weird circular flow of cash between the very companies driving the boom, and it might be the thing that's artificially juicing their stock prices. Okay, so here's how this crazy loop works. Step 1, Microsoft invests billions in OpenAI. Step 2, OpenAI immediately pays that money right back to Microsoft for cloud services, which Microsoft then gets to book as shiny new revenue. Step 3, Microsoft uses that income to buy a ton of chips from Nvidia. And then, to complete the circle, Nvidia invests some of its profits back into other AI startups. Think of it this way. You pay a friend $1,000 to dig a hole. Then he pays you that same $1,000 to fill it back in. You both now get to record $1,000 in revenue. And since revenue is a huge metric investors use to value companies, this financial merry-go-round can make these companies look way more valuable than they really are. And here's the real kicker. While all this money is flying around and valuations are soaring into the stratosphere, many of these core AI services are still not actually profitable. OpenAI, for instance, is reportedly still losing a ton of money every single month. Okay, that brings us to the second big red flag. And this one isn't about some weird accounting. It's about a fundamental physical limit to AI's growth. The market is betting on infinite progress, but that might just not be possible. For years, AI models have been getting smarter at this breakneck speed. Why? Because they've been feasting on every scrap of public data available, every book, every article, every website. But that all-you-can-eat buffet of human knowledge is about to close. And we're talking soon. Projections show that by as early as 2027, these AI models will have consumed pretty much all publicly available online content. Once we hit that wall, the rapid improvement we've gotten used to could slow to a crawl. And when that happens, the sky-high expectations built into these stock prices could come crashing down. And this really gets to the core of it, right? It highlights a fundamental difference between us and them. We humans learn by interacting with the world, by creating new experiences. But AI? It can only learn from the data we've already created. It can't go out and live a life to gain new wisdom, and that's a hard limit. So you've got this weird circular money machine, and you've got this data wall fast approaching. So what does it all mean? Let's tackle the big question head on. Are we living through another massive tech bubble? Okay, so after all that, is this a bubble? The short answer? Yeah, probably. But it's also a lot more complicated this time around. There are some really key differences between today's AI boom and what happened in the dot-com era. Here's the main difference. During the dot-com bubble, you had companies with literally no products and no revenue getting insane valuations just based on a catchy name. Today, the big AI players like Nvidia and Microsoft are making real, genuinely useful products with a clear, even if it's still unproven, path to making a profit. But, and this is a big but, that doesn't mean we're in the clear. Not at all. All the classic warning signs of a bubble are here, right now. We've got extreme overvaluations, questionable circular revenue we talked about, a geopolitical arms race between the US and China, and of course, those fundamental scaling limits. The only question really is what inning of the game we're in.
Okay, this is the part that really matters. Let's bring this all home. Given all this uncertainty, what's the smartest way to handle your money? What's a level-headed strategy look like?
Here's a clear three-part game plan. First, just keep investing, consistently, ideally in broad, low-cost index funds. Don't try to time the market, and for goodness sake, don't panic sell when things get rocky. Second, focus on increasing your income. It is the fuel for your wealth. The more you earn, the more you can invest, especially when prices are low after a dip. And third, and this is so important, diversify. Don't put all your eggs in the tech basket. Spread your money out across different things like stocks, bonds, and real estate to protect yourself. In the end, understanding all these forces isn't about panicking and selling everything you own. It's about being prepared. History shows us time and time again that every market crash creates enormous opportunities for people who stay calm and keep investing. So the real question isn't if the bubble will burst, but when it does. Will you be ready to take advantage of it?